Yeah, so Nitin Sacheti, I am a portfolio manager at ARS Investment Partners along with Steven. I launched my own fund, Papyrus Capital, in 2016, which is a long short fund. I was, at Tiger beforehand, and then I ran the TMT sector for Cobalt Capital. And then I brought Papyrus in-house into ARS last year. And so effectively, Papyrus is the long short fund within ARS. We have three major strategies. One is our all cap strategy. Another is our dividend oriented strategy, and then Papyrus, which is the long short strategy. For the most part, we try to look at tech companies that we think are really doing extremely innovative things, but the overarching theme behind all the businesses are that they're run by great management teams that kind of see trends ahead of everybody else and are really making moves accordingly. And I think this kind of Starlink situation kind of relates to that too, when you just have, again, very, very thoughtful people who are kind of thinking, again, 5 years ahead of everybody else. And, we're watching their moves and we're investing in those businesses. We're looking for, tangential businesses that we think are really disrupting. So that's sort of the overall, how we think about the tech sector within ARS and Papyrus. But that's kind of my background. Happy to get into some of the specifics of the presentation, Mark, unless there's anything else we should discuss before. So basically, what one of the themes that we're playing is really decarbonization. And I know, everybody's read all of the Economist did an incredible cover story late last year, or I should say, entire issue on decarbonization late last year. Bill Gates's book was amazing that just came out a few months ago. And I think all of this sort of speaks to what exactly is happening with climate change. And, for us, again, we're looking at the world and how it's changing and investing where we see the most disruption and structural change. And so I think one place where we see that right now is everything that's happening in decarbonization. And one of the ways in which we're playing it is really the materials sector. And so why we think it's interesting is just because, if you look at these two stats, in the second sort of major bullet, there were multiple commodity super cycles over the past 120 years. And I think the FT does a good job in a few articles of sort of walking through all of these commodity super cycles, and then talking about how nothing is really going to be as big as, even the US industrializing, or China, 100 years ago, China industrializing, in the early 2000s. Neither of those nor anything else is really as big as sort of the commodity super cycle we're going to see come from decarbonization. And, two stats on that is something like the average electric vehicle requires 6 times the minerals of an internal combustion engine car. And, for your average wind power plant for the same sort of unit of electricity generated requires 9 times the minerals of a comparable, gas power plant. That said, we all know that with decarbonization, there are certain commodities, oil being the one, where we expect long-term demand to decline. And so I think it's just really important when thinking about this trend to just think about just sort of the rising tides don't lift all ships here. There are certain industries and certain materials that we think are really going to benefit disproportionately from this decarbonization trend, especially between now and 2030, 2040, 2050, when certain countries sort of have set decarbonization or climate change goals. So just to get into the way the sectors in the commodities which we're playing, I think the three major ones for us right now are rare earths, copper, and steel. I think if I look at all of them, I think steel has, and I'll get into specifics as to why, but steel has a really good demand scenario and sort of declining supply scenario over the next couple of years, 2 to 3 years, which is really interesting. Copper, we think, is sort of a slow and steady increase in demand that outstrips current supply over the next, again, are sort of one of the most interesting ways to play this trend. I guess now starting with rare earths, I'll just get into sort of how we're thinking about it. So we're playing, the rare earths, NdPr, neodymium, praseodymium, and this particular rare earth is used in the magnets that go basically used in every magnet that doesn't, use the Earth's poles to move. And so these particular magnets, they all require NdPr. And then the magnets are used in the motors of the electric vehicles. And so your average electric vehicle has quite a few magnets and motors. And so if we look at something like the Ford F-150 Lightning, that's got two major motors, but then it's got sort of smaller motors around the wheel axis. And so what that essentially means is that your average electric vehicle uses something like 3 to 5 kilograms of NdPr, whereas your average internal combustion vehicle uses 1 to 2. And so what's so interesting about this is the price of NdPr is about $90 a kilogram right now. So that's, a couple $100 of content in an ICE vehicle, but then it's, double to triple that in EV. So now just talking, I'm going to move to supply demand of NdPr, and then I'll sort of get back to use in the car. So interestingly, if we look at supply demand in the world right now, because magnets are used in hard disk drives, they're used in a lot of electronics, supply essentially fully equals demand right now. But the nuance to that is that 2/3 of the world's supply is actually controlled by China. And so one thing you've seen is we're talking about, the government and the infrastructure bills before, but one thing you're seeing is the DoD wants to stockpile some of these rare earths. And so there's a big move to kind of make our supply independent of and so why that is, especially in the public markets, for us to play rare earths. And, the two major there are two public companies that are manufacturing right now the ore deposit for NdPr. And so we're involved in those. And then there are two other companies that we're involved with that are sort of pre-production. And so the pre-production is, are two businesses that they're in the process of getting the permitting for their mines done. So once that permitting process goes through, once they start mining the ore deposits, they'll start generating revenue. Now, what's so interesting here is that, like I mentioned earlier, the average amount of NdPr content in an electric vehicle is only $500-600 at the current price. So there's a lot of room for prices to go up, just because if we look at current supply of NdPr and then we project out all of the EVs that will likely be on the market based on all of the targets that the big banks and governments have for electric vehicle output by 2025 or 2030, within the next 7 years, we believe that electric vehicles will effectively take out all of the, buy all of the supply of rare earths that's being produced today. So that means that there's a lot of room for prices to go up, for new supply to come online, because there are other uses of rare earths, like I mentioned, in motors. And so again, what also is so interesting here is that your average car uses just a few $100. So there is real room for prices to go up. And so when we think about just sort of the increase in demand, how demand outstrips supply in rare earths, and where we think prices go, we think there's a lot of room to move. We think the two currently producing companies that we own We think that they're doubles or triples over the next 3 to 5 years. And then we think that the two sort of pre-production companies basically, simplistically will generate about the same production as the two companies that are currently producing that I mentioned, but they're trading at 1/10 of the market caps or enterprise values. So we think that, if our two currently producing companies, can double based on putting a 14 to 16 times earnings multiple on where we think earnings will be in a few years, right? So we're not being super aggressive with our assumptions. The pre-production companies, assuming that there are no risks to actually getting production up to date, they could potentially be 15, 20x returns. But obviously there's a lot more risk, so we size those quite a bit smaller than the companies actually producing. So that's sort of one way that we're playing. The next is copper. And I think this is, rare earths probably haven't been as well telegraphed, but I think copper has. David Einhorn had a great presentation in sort of the Ira Stone conference on tech in Freeport McMoran. So we're generally playing copper also, because we think that, again, your average electric vehicle has a lot more sort of conductivity, related wiring, and that's required for, basically to power these cars. And so your average EV requires 5x more copper than your average ICE vehicle. And, the grid is going to require updating. A lot of these electric car chargers that require something like stringing 4 110s together to get to 440 volts, like your current Tesla superchargers, that all requires a lot more copper. Same thing with wind power plants. And so as we, move towards decarbonization, we think copper is another way where demand outstrips supply. And it's not quite the extent of the upside as the rare earths, but we think it's sort of a great way to, invest again in the decarbonization trend. And then the last segment that we're playing that I'll mention very quickly is really the steel segment. And so the steel segment, the interesting thing about it is that you have a lot of high polluting steel mills in China right now. And what the Chinese government is doing is, as they are focusing on sort of zero net emissions, they are shifting steel production down. And so they're basically taking a lot of these high polluting mills offline, and then they're shifting to what are called EAF, or electric arc furnaces. And so those electric arc furnaces use a lot of scrap steel for production. But with this sort of shift to building these EAF steel plants and taking kind of legacy flat roll steel plants offline, you have sort of a reduction in supply of steel. And that's causing some of this higher, iron ore prices, higher steel prices. And so, one of the ways we are playing that is through, one company that's vertically integrated in steel, and then another company that is actually receives a royalty stream on some of the inputs that are also increasing in price that sort of trade in tandem with steel. And that sort of latter way that we're playing it gets something like a 10% plus dividend yield. So we're collecting a great yield as we sort of play this trend. And if we think steel prices have room to move up, that dividend yield increases proportionately. So that's kind of how we're playing, the material sector in a decarbonizing world in a nutshell. And then I think there was a question around which countries produce or have the deposits for NdPr. And the answer to that really is the US, Australia, there's some production in Europe. And then, one of the sort of dark horses that kind of came out through everything going on in Afghanistan is that there are some rare earth deposits in Afghanistan too. And then obviously one of the fears now is if the Taliban comes in or continues to stay in, should say, does China start to take over that supply, which makes it even more crucial for us to have, Western Europe-based or US-based or Australian-based production. And so I think there were a few other questions around, which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produce NdPr. And so I think there were a few other questions around which countries produ questions about lithium. Some people talk about cobalt. I think somebody else asked about nickel. And I think, yeah, this is just sort of the way, a sampling of the way we're playing them right now, and the most interesting businesses with the best risk rewards and the best sort of earnings power as we see demand outstrip supply. But there are plenty of other material sectors to play also, for what that's worth. So I think that's about it.
Nitin, what's the long-term play that, this is, I'm trying to figure out the time span that you're looking for this investment. Is this like over a 10 to 20 year time frame that this is kind of pushed out to for this analysis, or is this a shorter time frame?
So, again, why did I highlight these three scenarios? Because I think, there are plenty of great companies in sort of the lithium or cobalt space to play. What we like about these three segments of the market is we think that we can make money on them in the next 6 months and the next 5 years. And I think for us, if we can find, it's very hard to find businesses, again, that are run by great management teams where you can set and forget to some extent while you're just sort of monitoring the big picture. And I think that's what we like about these three ways to play. Like, I look at NdPr and I look at where prices are today, and I look at, our major investment in the space and what they're earning on current prices versus what they're earning on prices 30 to 40% higher. And we project that 30 to 40% price increase in NdPr happens in the next 6 to 9 months. As that happens, this company has room to potentially go up 50 to 75% over the next year. When we think, again, to the second part of your question, Luke, when we think about sort of the long term, I think, we have to monitor what supply demand looks like. We have to monitor where pricing goes. If there are, if Jeff Bezos goes to space and finds an asteroid with a ton of new materials that we can use, we have to monitor that risk too. But the point is that we just have to look at I think the setup for something like NdPr will make us money over the next 10 years, including the next 2.
Nitin, are you following any of the companies that recycle the rare earth materials? And is that viable?
That's a great question. So we're not following them as sort of investments right now, because I think the one factor we like to look for is real earnings power. And so the names that we're invested in right now, we think they generate sort of real earnings power that we can underwrite when we're buying the stock. I think the problem we have with some of that, and it's even some of the new plastic, I think there's a couple SPACs that had companies that do like recycled plastic. And the problem with a lot of these things, and there are even some that are doing sort of carbon capture. And I think the problem is that the jury's still out on which of these technologies actually work. And, can we actually, this is the same argument with desalinization like 10, 12 years ago, right? Can these things do it, and can they do it cost effectively? So we are not sort of invested in anything or very close to anything, anything that does that right now. But we are, obviously keeping our eyes open, and if anything really interesting or cool comes along that we think works, we'll take a look at it.
Are you looking at those as a potential risk along the lines of Jeff Bezos finding a meteorite to bring down to Earth and harvest?
I hope not. I was throwing it in there as a joke, but hopefully that. Well, I guess on one end, that would be great for us if we could produce lots of minerals cheaper, right, in terms of standard of living. But I don't know if that's a risk. We'll see. Aside from that, though, I think one other thing to point out is just that if these things can make us money in the next couple of years, and I think steel is a good example of that, where I don't know 3 to 4 years down the road if a lot of sort of steel plant EAF furnaces come online in China, does that then depress the price of steel? So, it is important to say we're looking at steel on just the shorter term time horizon, but the other two, the NdPr and the copper, we're thinking we make money for the long term on that too.
Hey,
Thank
how
you.
concerned are you with China cornering the market when it comes to mining copper among other precious metals, or just notwithstanding the space mineral harnessing of, right? And I don't know how they're faring in that department, but to the extent we're on land, how concerned are you?
I think copper, I think it's more of a risk of the three that I mentioned, it's more of a risk for NdPr than the other two. And so the reason I mention that is because I think copper mining and, it's in Chile, it's in Australia, it's all sort of all around the world. There's enough sort of copper mines and we know how to do it. I would say NdPr is where that risk is a factor, just because right now, even the companies that we are involved with, some of them still send the NdPr ore deposits to China to be refined. And they're in the process of sort of producing their own NdPr or refining capacity in the U.S. We've, obviously spent time with management, and we think, over Zoom, not in person right now, but we think that they have the ability to really do that. But the jury is still out again on something like that, where I think China has perfected that process around taking that raw NdPr and actually turning it into magnets. And that's something that the Western producers haven't done yet, just because this is such a nascent market for large scales. It's been around forever, but in terms of large scale, development, it's something people have only been thinking about now in the last few years with kind of changing the emission, standards. So I think that's somewhat of a risk in the NdPr side, if that makes sense.
Hey, Nitin, it's Rob Colorina. Quick question: what's the book split between domestic companies versus international companies, and or where they're based?
In the fund, basically about, I would say, about 65-70% of our investments are in developed. I should say 95% of our investments are in developed markets. I would say about 2/3 of that is in the U.S. So the international exposure is small. And for the most part, again, if we are investing internationally, we're invested with a management team that has skin in the game and whose incentives are aligned with ours. We're invested in sort of Reliance Industries in India, which I think is sort of a very interesting business. And we know that the founder, son, CEO, Mr. Chairman, his interests are aligned with ours in terms of stock ownership. So I think when we're investing internationally, we want to make sure that's the case, just because usually if you're not the guy on the ground locally, I think you're sort of the last to know what's going on. So for the most part, to answer your question, we're looking for as many of these trends we can play domestically, but when we find something really interesting, like the two that I mentioned that are sort of pre-revenue, we'll look internationally to get involved.
Hey Nitin, I know that streaming is a big deal in precious metals, but to be honest, this is interesting to hear that it's also available in something more base, such as steel. Does it work the same way?
I think, again, I think on the steel front, it's really a shorter term phenomenon. So what I would say with something like that is kind of buyer beware, where, you really have to be monitoring supply demand shorter term. I think with the two other sectors, and again, that's why I mentioned we like those more in the long term as well as the short term. I think that when you just look at current supply, potential supply, it's very easy to see why demand outstrips supply. I think steel is a little bit dicier, but that said, I do think the next few years are going to be, between the infrastructure bill and what we're seeing with China taking production offline, high polluting production offline, I think the next couple of years, we think at least, should be good for steel.
So do you think then that the 10% yield that you guys have on your strategy now is that going to be kind of short-lived because of that, or you see that as more persistent?
I think it's probably a couple years. And then I think, again, this is a mine where there's sort of a lot of capacity, right? So even if steel prices, I think that 10% yield potentially goes up to, 13, 14% based on where we think steel prices and iron ore pricing could go. And I think as it normalizes back to where it was, pre-COVID, we think that's still a 6 to 7% yield. And so I think the market is just, either the market sees that and is pricing it at 10 to 12% right now, because that yield isn't, perfectly sustainable. But, for us, given where interest rates are, and the limited risk we see in this business, and the years and years of production, it's basically a toll road, right? And so if you look at the way, you look at the CPG companies, the consumer packaged goods companies, and you look at the way toll roads are essentially trading in a low interest rate environment, we're happy to get 10 to 12 for the next few years. We're happy to get 6 to 7. So we don't think there's a big impairment on, our principal if, in 4 years, 3 years, steel prices revert back to, where they were pre-pandemic. And again, if we are in an inflationary scenario, which I'm not sure, I know what's transitory versus what's not, that's just an added bonus there.
Nitin, with your analysis, have you looked at companies that are going after the old fossil fuel slag piles or reclaim piles to extract minerals out of those to get rid of them?
Not in any detail, no. Make a note of that. Thanks.
Again, if you've got any insight on that, Luke, or anyone else, share in the chat.
Yeah, I'll have to dig up.
I
had a company that was looking to reclaim slag piles. They had because of newer technology in mining, chemical and dry processes.
I just
extract
Kim Cole
out of it.
I was just going to mention, Kim, I just saw that you put something in there. I know that you posted on this. Do you want to maybe make a comment?
Hi everyone. No, I wasn't planning on making a comment. I just thought that in addition to some of the trends that exist, and I happen to agree with, I do think there are some mitigating factors, and I just dropped those into the chat as well. And maybe not mitigating factors as much as other opportunities to consider. Like, we're looking at a lot of new materials where they've taken basically existing materials and with new technologies or new mixes of technologies made them much thinner, or decreased the ratios, or used new types of compounds to structure them together with equal types of performance. There's so that new technology and existing materials used in different ways, as well as I'm on the board of a company that will be disrupting motors, electric motors. They use absolutely no rare earth metals at all, switch reluctance motors, electromagnets instead. So things like that, I think, are interesting to take a look at.
Kim, how long before these non-rare earth constructions or technologies come online, do you think?
They're already online. And they're in all stages of development. This particular one, Turntide Technologies, is already online. They are already selling in very high volumes to the agriculture space and to HVAC systems in buildings. They just bought a company in the electric motor space that they're going to be integrating the technology into. In terms of like the material science companies, they're really in all stages. I think it really depends on how much capital they get to scale, and if there are any risks in doing so and performance over time.
That's
Just another
You're
exciting
welcome.
space to
Well,
watch.
Sorry, just to
No, you're
add
welcome.
to that, one of
You're
the,
welcome. Go ahead, Ned.
no, I was just going to say that one of the things that, you know, as we were sort of looking at substitute, you know, a number of sort of experts in the industry, most of the competing, you know, motors don't have the same ability to, they require more weight to the motors to actually power them. And so the issue you have with electric vehicles is you need the motors and you need the magnets that are kind of that pull the most using the least amount of weight themselves, because if they weigh more, then that's just adding more weight to the car. And so, you know, alternative induction motors, which is kind of the other more popular or common one that could be used in something like hard disk drives, which are stationary, can't be used here. And in order to get to, we were told was in order to get to kind of cost parity, because, you know, you would have to have, you know, yeah, a much bigger motor to pull. It would be like 15x the cost of, you know, of an NdPr motor. So I think, you know, in any of the industries where we're looking, there's sort of always, whether it's, you know, we've been invested in the cable industry. I've been invested in the cable industry for about 12 years on sort of the broadband pipe. And, you know, in that investment, people have been sort of talking about substitutes that would just intermediate like wireless, and sort of nothing has really come to fruition. So, you know, again, it's something we're monitoring, but there, in every industry where there's a lot of big disruption, there are, I just feel like there are always science projects. And so, you know, I think not to take away from some of the companies that are discovering this, because, you know, there's clearly always breakthrough innovation, but so far, just from our work, we haven't really seen, you know, anything that could substitute these motors yet. But maybe I'll reach out.
I agree with that. I actually think that it depends on what time frame you're looking at, and in the intermediate, you know, the short to medium term time frame, the amount of supply that we need to fit the demand is just going to be so much more than we can even anticipate, that you're going to see some pretty big price surges. And I think that the plays that you have identified are, you know, are really exciting. I think longer than that, however, there are companies that are further along than science projects, but they do need help scaling, and that just takes time with, you know, physical manufacturing. And there's some amazing battery companies that are solving for the weight issues as well. But again, you know, those need some time. So
Yeah, maybe I'll reach out to you offline to get the name of the company, because I'd love to learn more about it too.
Yeah, Kim is a wealth of knowledge. Kim, your name came up this morning. I was on with Charles Way, and he said that it was the president of the CEO of the Hall of Fame itself, reading his name, Baker. Does that ring a bell?
he is the
David Baker.
David Baker runs the
Hall of Fame
nonprofit.
itself.
The nonprofit. Yeah.
Charles said if David Baker was speaking and part of what we're doing, that he would bring Tiki Barber and Strahan to Canton. So, and I had a really good talk with your fiance, Mike, but we'll hit on that later.
Yeah. That would be a better conversation with him.
So we should have more. We should go into this subject further. You know, Nitin, Kim, you go offline. Sounds like a lot of people here that have got some. We come and talk about the circular loop economy events, but we should we should pick up on this theme more deeply. Any other comments, questions?